Bloomberg Audio Studios. Podcasts, radio, news. This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, what can I say? Rich Bernstein, rock star, former chief strategist at Merrill Lynch, just an incredibly storied career, who has managed to put together such a straightforward and intelligent way to approach asset management. Rather than me babble, I'm just going to say this is a fascinating conversation. With no further ado, my discussion with Rich Bernstein Advisors, Rich Bernstein.
Thanks, Barry. Great to be here. Thanks for the invitation.
Oh, well, I'm thrilled to have you. I thought you would be the perfect person to talk about what's been going on these days. But before we get to that, let's start with Bachelor's in Economics from Hamilton, MBA from NYU. Mm-hmm. What was the career plan?
So the career plan was kind of foiled, I would say, 6 months after graduation. So oddly enough, when I graduated Hamilton, I wanted to be a labor economist. Mm-hmm. And people say, like today, they go, labor economist? Like, what's that all about? That was
a big thing at one point,
It was
right?
a big deal. And so it was, you got to remember, labor unions were very powerful in the late 70s, early 80s. There was rampant inflation, and every company had a labor relations department. It was a growth industry. And so I decided I wanted to be a labor economist and got myself a job with a prestigious economic consulting firm in their labor economics department, doing all kinds of government-related work, private sector, but government-related work. And we were consultants, which is very critical because consultants bill by the hour. And literally the day after, so Election Day is Tuesday in 1980, November 1980, Wednesday, 50% of our business basically went away.
Because Ronald Reagan was elected
took over,
president.
Everybody called up and said, stop billing. We want to see what's going to happen under the Reagan administration.
Wow.
Now, I wasn't the smartest guy in the room, but it was pretty clear to me that this was no longer a growth industry. I had taught myself Fortran, dating myself here quite a bit. I taught myself Fortran and was a pretty good computer programmer. And a friend of mine who had gotten fired from this economic consulting firm got a job at Chase Econometrics, IDC, and said, you have to come over here. You're a great programmer. You're going to love this stuff. They had the largest set of economic and financial databases in the world at the time. He goes, you have to come here. I said, what do I want to go to Wall Street for? I mean, like, I have no interest in Wall Street. Why would I go to Wall Street? And he said, well, let's be honest here. The salary is twice what you're making.
Wow.
I said, well, I'll go for the interview. I'll see what happens. Well, I went for the interview. I got the job. My biggest client turned out to be the Merrill Lynch Investment Strategy Group.
Huh.
And that's how I got involved in Wall Street. And I found through time that I really liked it. Went back and got my MBA, and after a while, without sounding stupid about this, realized I knew more about this stuff than many of my clients did. And so I just worked my way through Wall Street and eventually, But if you had said to me when I graduated at Hamilton that I was going to end up being the chief investment strategist at Merrill Lynch, I would have said, you're crazy.
You would have laughed. So I have to ask about Fortran. Mm-hmm. You're undergraduate, your focus is economics, you get an MBA in finance. Where did the computer programming skills come from?
I am the poster child for the liberal arts education. So I almost double majored in philosophy. I didn't. I was too lazy, to be perfectly frank, and didn't want to take one of the intro courses. But I took 5, 6, 7 philosophy courses, something like that. And for all the philosophy majors out there, I'm sure they know that a good part of philosophy is symbolic logic. And symbolic logic, what is computer programming? What is computer languages? It's just symbolic logic. So when I got introduced to Fortran, the first day I realized I could actually read a lot of the code because it was just symbolic logic.
So it's so funny you say that. Philosophy is symbolic logic. Study of law is a lot of symbolic logic.
Absolutely.
Obviously, math, there's a ton of symbolic logic. Wherever you look, that classic syllogism, right? Here is the fact pattern. Here's the applicable set of rules, programs, parameters. Like, this seems to be a very constant thread in a lot of areas.
Right.
How surprising was it to you that, hey, philosophy has been really helpful on Wall Street?
It's been amazing. In fact, in one of the books I wrote many, many moons ago, I specifically thanked one of my philosophy professors I took symbolic logic with him. I think I took a course in relativism with him, all these different things, which have definitely been influential in my career, without a doubt.
All right, so you end up at what could be my favorite advertisement, which was the E.F. Hutton ads back in the 1980s when E.F. Hutton
I think it was
talked.
actually the 70s into the 80s, yeah.
When E.F. Hutton talks,
Right.
people listen.
Yes.
Like you can find these ads all over YouTube. They're seminal.
fantastic, yeah.
How did you make your way to E.F. Hutton from Chase Econometrics?
So what happened was that at the time, a lot of people at Chase IDC were in very high demand. We were the beginning of the quant movement on Wall Street, right? And so there were a lot of people who were getting hired away. One of my friends, who was more an economist as opposed to a quant guy, got hired by the chief economist at E.F. Hutton at the time, and there was an opening in the investment strategy group, and he said similar, like, why don't you come and interview?
Come double your salary again.
Yeah, well, it didn't do that, but it was an opportunity. So I grabbed at the opportunity. I worked at the time with a wonderful guy named Jeff Applegate, who unfortunately passed away recently. But Jeff was a great role model in terms of how to make Wall Street understandable to non-Wall Street people.
Mm-hmm. Huh, really, really interesting. And then we get the 87 crash.
Right.
And then the following year, you join Mother Merrill.
Right.
Tell us how you found your way to Merrill Lynch.
So Merrill, Hutton went out of business on basically end of 87. I think it was December of 87.
What was that? Did they go out a bit? Wasn't it Shearson, Lehman, Hutton, American Express, or something like that?
It became Shearson, Lehman, Hutton. The irony of which, I once worked at Shearson when they merged with Lehman Brothers, and I lost my job there. And now Shearson Lehman was merging with Hutton, and I lost my job again. So I was on the losing end of many, many mergers of the 1980s. But it was getting to Merrill was. I was out of work for a while after Hutton went out of business. I had met with a headhunter, and the headhunter had set me up with an interview at Merrill, and Merrill kind of passed on me, but then called me back about 4 months later. And,
so their first choice turned them down. Is that what you're saying?
What actually happened, I found my personnel file years later.
Yeah.
I found my personnel file, and this is actually kind of funny. And in it was the headhunter letter to the hiring manager. And it described me as being the cheapest of the lot with the most potential. That was the way the guy described me.
You're a value stock.
I was a value stock. And so I think what happened was everybody else they were talking to wanted too much money, and they worked their way down, and they found they got me.
That's unbelievable. How did you get access to your personnel file?
It was by accident. It was it was like switching managers type thing, and somehow it got put into the wrong file, wrong set of files, and there was mine. So of course I read it.
So you were at Merrill for 20 years? Is that right?
Almost 20 plus. Yeah, right.
Wow, that's amazing. You were there right up into the financial crisis.
I was.
What was Merrill Lynch like right in the middle of that storm?
So it was, I think it was an interesting time, and I should say first of all, the Merrill was a fantastic place to work.
Totally,
it was. Anybody out there who has worked at Merrill, knows the feeling that I have for the firm, and because they feel it too, and it was a great place to work. The corporate culture began to change in the few years before the financial crisis, and we got a little bit of ways from our roots. Our roots were very much as a private client-oriented firm that also had great trading and investment banking and everything else. But the heart of the firm was still on the private client side. For any number of strategic reasons, the firm decided that we wanted to change that emphasis. And I think, it's kind of dangerous to take a lot of risk when you don't really have the experience doing it.
Sure.
And so I think that's kind of what happened to Merrill.
I mentioned the E.F. Hutton ads, but for the people who are listening who are younger, I want to say in the 1970s, maybe even in the 1960s, Merrill Lynch ran a series of television ads. Merrill Lynch is bullish on America.
Absolutely.
With the thundering herd and the big bull, and
right.
It was pretty amazing when we talk about the democratization of investing. That Merrill is arguably one of the first companies that
Absolutely.
dove into that head first.
Yeah, if I'm not mistaken, Charlie Merrill his whole philosophy was bringing Wall Street to Main Street. I think he actually coined that phrase.
I think that's right. Yeah. And later on, we had a number of the discount brokers had come out in places like Schwab and Muriel Siebert. But I always felt they had followed Merrill's lead to we're going to push into Main Street.
Yeah.
So you start out essentially as an analyst. How do you work your way up to market strategist and then chief investment strategist for the Thundering Herd?
It's it's funny. One of the things I always tell recent graduates of colleges is don't try to plan out your future. Because when you're 21 or 22, you have no idea what you're going to do when you're 25 or 27 or 30. Right. You really don't know. And my example of, the changes after the Reagan-Carter election are pretty clear on that one. But the same thing was at Merrill. I came in as a quant analyst. I was there not for any other reason, to be perfectly frank, and I think the people involved at the time would agree with this, that in institutional investor, there was a quantitative analysis slot. Merrill had nobody who was there. They thought, well, let's get somebody who can maybe run for this slot. We'll get another II vote, and we'll see what happens. And I was their choice to just kind of become this quant guy. I don't think they knew what to do with me. I don't think they were thinking anything else other than go do your thing, and hopefully this will all work out.
Here's an empty desk, Rich. See what you can do.
Exactly right. And it was actually kind of funny. I truth be told, now I can tell this. I lied about my age to get the job.
Saying you were younger or saying you were older?
Older, because I was 29 when I was interviewing for this position.
Yeah.
And I knew that, and back then you could ask people how old you were.
Right. And they couldn't Google you and find out.
Right, and they couldn't find out. Yeah, so there was all kinds of stuff that they could do back then that you can't do now or can do now.
Did you really get an MBA from NYU?
I did.
Did you just pad your resume?
No, that's legit. That's 100% legit. But so what was happening was I knew that if I went to these interviews and I told people I was 29, they would think I was a kid.
But 30 sounds older.
30, it's like $29.99, right? Like you just round up,
It was a 6-month fib. That's all it was.
Well, by the time I actually got the job and showed up at Merrill, I was 30. So I've never felt bad about it because I was asked in every single, why would they ask? They wouldn't ask unless they thought maybe I was too young. That would be the impetus for asking the question. Nobody's going to ask the question.
Well, how much
much
experience and seasoning do
I
you
don't
have?
think that was the root of the question, and because they had my resume, they knew exactly. And so it was really how old is this guy? Can he really do this? And so I lied. So I told everybody I was 30, and but
that's hilarious.
Yeah, it is kind of funny.
And nobody ever figured it out. Don't they, when you're filling out your paperwork and
nobody took the time.
Nobody cared. Nobody. If you're a W-2 employee, they get your date of birth and your social security number. It's not like the data isn't there.
But by the time I got to Merrill, I was 30.
So nobody thought twice.
Nobody thought twice about it. Yeah,
that's really funny. So you're at Merrill for 20 plus years. We have the financial crisis, and you decide to launch Rich Bernstein Advisors in 2009. So in hindsight, it turns out to be perfect timing.
Right.
What sort of pushback did you get when you're like, I think I'm going to stand up my own shop into this mess?
Yeah, I left Merrill because I'd gotten burned out. I mean, one of the things that people don't realize is, as a sell-side analyst, the better you get at your job, the demands on your time grow exponentially. And so I was traveling all over the world. I was nonstop writing. I mean, I had burned out. And I tried to leave Merrill several years before, and they convinced me to stay. They said, no, it's okay. We'll take care of you. Everything will be fine. Don't worry about it. But in 2008, in the financial crisis, I turned 50. And so, not lying about my age, I actually did turn 50. And I was pretty burned out. And then the financial crisis hit, and I thought, it's the wrong time to leave. It'd be irresponsible for the chief strategist of Merrill Lynch to leave in the midst of a crisis. That's just very unfair to our clients, very unfair to the firm. I rose to this level. I have a certain amount of responsibility. I can't be selfish on this. So I stuck it out for a while. And then Bank of America bought Merrill, and they were great, and everything was good. But it was clear to me I wasn't going to have more fun. Right. The burned out nature was going to continue and
this was only going to get worse.
It was going to get worse. So I just figured, why do this? So I decided I was leaving. Again, Merrill was fantastic. They encouraged me to stay. I just said, no, thanks, but I'm done. Stick a fork in me, I'm done.
Hey, 20 years is a long time being a road warrior.
Yeah, exactly. And so then the question was, well, what was I going to do? I had toyed with the idea of opening an independent research shop and that sort of thing, but that was going to be equal amount of travel all around the world, and I had just done that for 20 years. Didn't sound like a lot of fun. But then the idea came to me, well, maybe we should put some of these things that we've developed through the year, put it into practice and see if we can manage money doing it. And we were kind of forming the firm, and we were like really in its infancy. And then all of a sudden, I remember exactly where I was. I was in our den. Weekly initial jobless claims had just come out. This is like in July of 2009. And the number came out, and it was a blowout good number.
Right.
And I said to myself, this is a rogue number. And then I said to myself, well, wait a minute. Why is it a rogue number? Maybe things are just getting better, because I was listening to all the talking heads
who were all still,
and they were all negative as all get out. And I said,
let me stop you right there, because my next question is, I very vividly remember March 2009 and saying, hey, U.S. equities down 50%, usually pretty good entry point. I think we finished down 56, down 57%. Right. But the bearishness, the negativity persisted, and it felt like people were really suffering from a little post-traumatic stress disorder.
100%.
I'm curious exactly how, as you were starting to tell us, how you were thinking around that, because everybody was so negative, and yet the data was clearly improving.
It was definitely improving. And so, the way I described to people is I said, markets don't move on the absolutes of good or bad. Markets move on better or worse. And things were horrible in an absolute sense, but they were getting better.
And certainly better than consensus felt like it was.
Absolutely. And so, I remember exactly where I was, and I said, well, gee, this could be like a big bull market. And I actually at one point said to potential investors, I thought that we were entering the biggest bull market of our careers. And so
you were only off by a tiny little bit. Yeah. It was of our careers?
Of our careers, yeah.
If you look at rolling
to today.
Rolling 15-year periods from 2009 to 2004 was 16% a year.
Yep.
From the 15-year period ending in 1999 was 17% a year, and you go to the 15 years after World War II was 18%
so we're right
a
up
year.
There.
But one of the best periods in modern history, for sure.
Absolutely.
So you're like, hey, this is going to be good.
So if you're going to start if you're going to start a firm, this is the time to start.
For sure.
So that's kind of how it began, and I don't want to say that everything went swimmingly at the beginning. No, you're starting a firm. You have, like any startup, you have pluses and minuses, and you hem and haw and you do different things. But through time, it's worked out pretty well.
So what was, we stood up a firm in 2013. I'm curious, and that experience was kind of surprising. I'm curious, what was the most surprising things about launching your own firm? What was I didn't expect to be doing this.
So two things. One was that I was getting into an area that I didn't know, and I knew I didn't know the buy side the way I knew the sell side. I knew that. And what I didn't know was how much I didn't know. Mm-hmm. And so the early fits and starts were trying to hire the right people. I didn't even know enough to hire the right people. Eventually that did happen. And we hired a guy named John McComb, who's still the president of the firm. But it was kind of, off and on, we were not doing all that well at the beginning, largely because I didn't even know who to hire and who not to hire, because I was so inexperienced on the buy side. So that was surprise number one. Surprise number two was that people would not invest with us at the time because we were too bullish. And that was fascinating. That
just makes you more bullish, doesn't it?
It did, without a doubt. I mean, but if it was incredible. We were, at the time, people were very cautious on the United States. If they wanted growth, whatever they determined that was, it had to be in the emerging markets. It could not be in the United States. And we were bullish, and we wanted to invest in the United States. And people just couldn't deal with that.
I'm going to put a little flesh on what you're describing. I vividly recall writing a market commentary I want to say September, but maybe it was October '09. And the title was The Most Hated Bull Rally in Market History. Same experience?
Absolutely. It was very frustrating. If you look at our early marketing materials, you will find comments about what we called fire extinguishers.
Right.
And fire extinguishers were positions we would take in the portfolio that we could pull off the wall and put out the fire in the portfolio. Right? Like having cash or gold or all these different things that we would include in our multi-asset portfolios so that people would feel more confident in what was going on. No, it worked, but it didn't really work because
it worked psychologically, but it didn't work performance-wise.
It worked for us fine, but it didn't get people across the goal line. They would not. They were too scared.
How long did it take before people started to say, "Oh, maybe this Bernstein guy is onto something"?
Yeah, well, everybody talks about it being like a hockey stick. The raising assets is sort of like a hockey stick where you think of it as a turbocharger, where you're kind of going along and all of a sudden the turbocharger kicks in and you start really accelerating. That was the experience that we had in the firm. We had people who knew us as a group, were reasonably willing to invest with us, but to the broader audience, it was much more difficult. And then as they got more confident, of course, the turbocharger started revving up. Yeah.
So was that 6 months, 12 months, 18? How long did it take?
I would measure
2
it in
years?
I would say I would measure it in years. I think,
really?
Yeah, I think I don't remember the date of when we hit $5 billion. But I'm going to say it probably took us 5 or 6 years at least to get to $5 billion.
And now you're well over $15 billion.
Yeah, we're about almost 16. Right.
Wow, so that's amazing, and this is now 15 years later.
Correct.
Right? So it took you 15 years to get to $15 billion. Yeah. So $1 billion a year, not too shabby,
bad.
Right? Not bad at all. So we were talking about launching the firm in '09, and there's a quote of yours that has always stayed with me, which is, quote, "When the sell side indicator turns positive, leaving the firm is preferable to going on the call and telling everybody about it." Explain that, because we were talking earlier about the sort of bearish PTSD pushback to anything remotely positive. Your indicator, this sell-side indicator, has a pretty long and storied track record at Merrill.
It does.
Hey, this turned positive. You guys have to change your views. That carries no weight?
So let me explain what it is. The sell-side indicator is a sentiment indicator that's based on Wall Street's consensus recommended asset allocation. So stocks, bonds, cash, how much did you put in stocks at any point in time? I started that all the way back at E.F. Hutton. You mentioned Hutton before, and we continued it through Merrill, and Merrill still runs it today. It really just looks at the equity allocation and puts basically standard deviation bands around that. And as you might expect, when Wall Street gets really bullish, that's a bearish sign. Right. Wall Street gets really bearish, that's a bullish sign.
So when you said this turned positive, it was because the street was so bearish.
Got incredibly negative. And so from my point of view, and what you're referring to was that, do I stay at Merrill and try to convince everybody to be more bullish, or do I go off and start my own firm? And I just thought it'd be better, given all the other things we've discussed, it was better to start my own firm.
Preferable to going on the call and telling everyone about it. Yeah. Like, I could just imagine the sort of pushback. Bernstein he's now a permabull. He's crazy. We just are in the middle of this crisis. How on earth can we recommend clients buying equities?
Right.
That's the sort of stuff you
and it was the kind of thing where, certainly on the private client side, for those of you to remember, in 2008, 9, 10, 11, 12, the story was all about bonds, and
right.
Nobody wanted the risk of equities. And if you twisted their arm, maybe they would invest in large cap, high quality, dividend paying stocks. Right. But there was no way that they were going to take any kind of beta risk.
So no technology, no growth firms, nothing with any amount of potential volatility.
No. Volatility was terrible. Risk taking was terrible. They were under their desk in the fetal position.
And in hindsight, was there a better time ever to put money into those sort of stocks?
I'm not sure in our careers there has been. Maybe 82. Right, if you think back to 82,
right in the beginning of
maybe 82 was a time, and I do remember that. I'm old enough where I do remember what the sentiment was like. And certainly I had very little experience on Wall Street. I know what my sentiment was like in 82. I couldn't believe that the market would be going up. And
you just had a 16-year bear market.
Yeah.
You finally got over 1,000 on the Dow, which I want to say we first kissed in 66.
Something like that.
Right?
Yeah.
So it's 16 years later.
Yeah.
Again, everybody seems to always be looking backwards, not forwards.
And so the lesson from that, when I was a young pup was, I really didn't know what I was talking about. And I learned that from various people working on Wall Street. And, so when it came to 2009, I was kind of determined not to make the same mistake again.
So it's funny because another quote of yours kind of cracked me up that I always found this intriguing. You suggest always have a 10% annual target for the S&P 500 despite being bearish. I love that optimism, but how can you maintain that bullishness when you're bearish?
Yeah, so what Barry is, as I'm sure you know, the sell-side strategists are always pestered for their target.
Right.
What's your target on the S&P? And I used to think that was the most watched, least important thing I ever did.
Right.
And so I would never put a number out. I would never give people a firm number, but I would always answer the question by saying, well, we don't really have an official target, but we have a 10% expected return. And nobody ever noticed that 10% is roughly the long-term average return of the S&P.
With dividend reinvesting, 10 and change.
10%. So I used to always say 10%, and that would make everybody happy. And so regardless whether I was bullish or bearish, I always answer the question saying, I don't know, we have a 10% expected return. And that kept people satisfied. But I really don't think that the notion of what is your target is an appropriate thing to discuss as an investor. Look, if you want to be a trader and you want to do a lot of short-term trading, I get that and I understand it. For a true investor, I think it's kind of a silly discussion.
Really, really amusing. On your website and elsewhere, I've seen the phrase from you, pactive investing.
Yes.
Define what pactive investing is.
Right. So pactive, which is a trademark term.
So that's literally
RBA.
My next question. Yeah. I saw the registered trademark.
Yeah, it is a trademark term of RBA.
You literally did that. That's great.
We did that. And so pactive stands for the active use of passive investments. And what we're really referring to here are a lot of ETFs. And, we're a macro firm. We claim to know nothing about Coke versus Pepsi. Right. But rather, we look at size, style, geography, and, asset allocation, things like that. And ETFs are right in our wheelhouse. It's been a great invention, and we're very big users of ETFs. Jack Bogle I met many times when he was alive, and I always thought he was one of the smartest guys I ever met in my career. But one of the things and Jack would always say, don't talk to an active manager, just go buy an index. Right? Okay, fine. But what Jack would, and that's an interesting discussion. We can have the discussion all day long as to why that happens or doesn't happen, whether he's right or wrong. But the one thing that Jack would never tell anybody is what index to buy and when.
Right.
And, one may say, well, that sounds silly, but there's been many times in the past where if you had bought the wrong index at the wrong time, your portfolio suffered dramatically for an extended period of time. For instance, if you had bought NASDAQ or even the S&P ETF in March of 2000.
For sure.
Right? You then entered the lost decade in equities.
Right.
And your return for a decade was slightly negative. If you had been in other things like emerging markets or energy or, all kinds of small caps, all these different things, you would have done fabulously well. If you bought small caps at the peak of the small cap bull market in 1983, it took you 17 years to catch up to the S&P.
Wow.
So you would have been neutral. So, everybody says, I'm a long-term investor. I'm just going to buy an index. If you buy the wrong index at the wrong time, it can have a real detrimental effect. And that's what pactive investing is supposed to be all about, is the active decision-making around these passive investments.
So let's delve into that decision-making. How do you decide which index is the one that you want to own What data are you looking at? How are you crunching numbers for this?
Right. So Barry, I mentioned that we are macro investors. We're not looking at individual stocks. So everything we do is going to fall under some macro umbrella of one form or another. And the way to think about it is it's going to fall into three categories. Everything we look at is going to fall into three categories. Number one would be corporate profits. One of the things that I wrote about extensively, even when I was at Merrill and through my entire career, is I've argued that equity investors spend too much time worrying about the economy and not enough time worrying about corporate profits. The stock market doesn't really care about GDP. The stock market cares about corporate profits.
Because the GDP is reflected in profits if it's trending
GDP,
the right way.
GDP is going to be a contributor, but a lot of other things contribute
right.
to corporate profits. We're looking at corporate profits and profit cycles, not economic cycles. Number two category is going to be what we call liquidity. And liquidity is going to be anything from central bank actions to lending standards from banks, anything that's going to allow more leverage and greater liquidity and investable assets in a stock market. And then number three is going to be sentiment and valuation. Now, sometimes people say, well, sentiment and valuation, why are they together? And my answer to that is...
One drives the other, right?
Yeah, my answer is that valuation is a reflection of sentiment.
Has to be.
Yeah, you can't have an overvalued asset that people hate or an undervalued asset that people love. That doesn't make any sense.
Right.
So valuation is going to reflect sentiment. And so what we're basically looking for, if you think about those three categories I just mentioned, we're looking for situations where fundamentals are improving, liquidity is adequate or getting better, and everybody hates it. Or vice versa, where fundamentals are deteriorating, liquidity is drying up, and everybody loves it. We're going to try and stay away from that. That's maybe a gross simplification of what we do, but that's kind of what we do.
But that's Pactive. That's how you're selecting from broad indexes just the right index at the right time and avoiding the wrong index at the wrong time.
Correct. That's exactly what we're trying to do.
Really interesting. One of the things that comes up when we're talking about various style investing comes right from one of your books, and it's about media noise. Yes. How do you focus on the right index when there's so much noise and so much stuff going on, and it's, especially with algorithmic social media, it's just a fire hose
it's crazy.
Of nonsense.
It is crazy.
How do you separate the signal from the noise?
Yeah, so I wrote a book in 2000, so 25 years ago.
Wow.
I wrote a book that was called Navigate the Noise.
I remember that.
Investing in the New Age of Media and Hype. 25 years ago, I wrote about the new age of media and hype.
You were ahead of the curve.
You think it's gotten a bit worse since in the last 25 years. So
just as a reminder, this is pre-Twitter, pre-Facebook, pre-LinkedIn. Forget Instagram, TikTok. Like, this was just like message boards and websites.
Yeah. I mean, you're just beginning to get websites in depth, but we're really still talking about a period of hard copy research reports and television.
Wow.
That's really what, the mainstay of what people were looking at. The point of the book was to say that building wealth for an individual investor is actually not that difficult. Why don't people do it? Why don't people do this? Is kind of silly.
Wait. When you say it's not that difficult, we intellectually understand. Like my friend Dave Nottig loves to say, investing is a problem that's been solved, but the problem that hasn't been solved is the human behavior around it.
Exactly. And so what the book tries to argue is that there's some very sound principles that everybody should be following to build wealth. But yet there's this siren song, if you will, if you're into Greek mythology. There's a siren song of things telling you, of noise telling you that there's something newer, better, get rich quick, all these kind of things that are going on. And to continue with that, your portfolio follows that sound and crashes on the rocks, if you want to, the mythology example. And so what the book says is the way to solve this problem of this incessant noise is to hardcore follow a process, and come hell or high water, you're going to stick to that process.
That's the mask you tie yourself to.
That exactly right, and put the wax in your ears, the whole routine, right? And that's what we do as a firm. We have a very hardcore process. It's macro driven, but we're going to follow that process, come hell or high water. It's funny. People understand that, and they understand what we do. We understand why they do. They understand the notion of the book. But yet they get very angry when we're not following the siren song of what's the newest, baddest,
shiniest object that's out there.
It's crazy.
So walk us through the process. I know you have a couple of core beliefs in your process. Tell us about it.
So I mentioned profit cycles. I think for us that is the most important part of our process. And as I said before, people spend too much time worrying about economic cycles and not enough time worrying about profit cycles. Now,
define
what's the difference?
profit cycle, and because we are all familiar with the business cycle and the economic cycle.
Exactly.
What is a profit cycle?
So whereas people look at GDP growth or industrial production growth and they say this is the economic cycle, what we're looking at is corporate profits growth. Now, let's just, as an example, we look at profit cycles all around the world, but let's take, for example, the S&P 500. The U.S. profit cycle. What happens is the difference between an economic cycle and a profit cycle, number one, is that profit cycles tend to boom and bust. Fortunately, the overall economy does not do that on a regular basis. And secondly, profit cycles have a shorter periodicity. So you can get multiple profit cycles in one economic cycle.
Periodicity, meaning...
the amount of time.
Right, got it.
Right. So whereas an economic cycle, maybe it's going to take 4 or 8 years, you could have multiple profit cycles in that 4 or 8 year period.
So how do you define the peak and the trough of a profit cycle?
So what happens is, if you look at the growth rate of corporate profits, you will see it follows a pretty normal cycle through time. And our challenge as investors is to find indicators that will allow us to effectively forecast that profit cycle. Now, we don't really care whether the profit cycle, whether earnings growth is going to be 7% or 8% or 10%, which is a very common question people get asked, or -5 or -6 or -7. We kind of want to know, is it getting better or is it getting worse?
Trending up or down.
Exactly. So if profits growth is 5%, what's the probability of it going to 10% as opposed to going to 0? So we spend an awful lot of time with a lot of indicators that look at that. What do the indicators look at? Well, look, profitability is a pretty simple formula. It's how much stuff are you selling and what's your margin per item. I mean, that's really all profitability is.
Well, but there's a couple of factors that go in. What is the cost of capital and credit and the inflation rates?
But that would be in your margin, right? I mean, and so...
Which affects profits.
Which affects profits. So all our indicators are either going to try to figure out how much stuff is, let's take the S&P 500, our S&P 500 company is going to sell and what's going to be their margin per product. So margin, as you point out, could be interest rates, it could be labor costs, it could be pricing power because of inflation. People forget inflation isn't bad for a lot of corporate profits.
For equities, for sure.
Right.
We certainly learned that during the pandemic.
Exactly. So those are the type of things that we're looking at in terms of profit cycle. And as I said, we look at profit cycles all around the world. We look at them by region, by country. We look at by sectors. We look at profit cycles for, say, the tech sector, for the consumer staples sector, or something like that as well.
So profit cycle is one of the triad.
It's the key.
All right. What are the other elements that you're considering in addition to the profit cycle?
So next would be liquidity. Okay, and liquidity is a function of several different things. It's obviously a function of monetary policy. We follow monetary policy in 43 countries around the world. I know that sounds silly. And obviously in the G7 or G10, you get a lot more information than you would in some weird emerging market country. But we do follow central bank policy. We follow yield curves, the slope of the yield curves, right? Whether you've got a bullish steepening of the curve. In other words, are interest rates coming down, but the curve is steepening? Or interest rates going up, but the curve is steepening? Or is the curve inverting? I mean, we look at all these different things. They have different implications for sector rotation and things like that as well. So, and then we follow things like bank lending standards. Now, that's obviously, you can only get that in the most developed countries.
Right.
But that's an important consideration as well. Are banks tightening credit or easing credit? People say, well, doesn't the central bank control that? Well, not really. You can kind of lead a horse to water, but you can't make it lend. And so you want to look at both central bank policies and the willingness of banks to lend.
How does the role of fiscal stimulus and spending play into liquidity issues? Yeah,
so to some extent it does. It's going to affect more. It's going to feed into ours more to the corporate profit side in terms of how much stuff are you going to sell, right? Because fiscal stimulus is trying to stimulate consumption or aggregate demand, if you prefer to be a real economist here. It's going to try and stimulate aggregate demand, and that'll show up in our stuff type
All right,
variables.
so we have the profit cycle, we have liquidity, and what's the third?
The
part of
third
the
is
triad?
sentiment and valuation.
Right.
Okay, so obviously we prefer to look at more undervalued situations. Sentiment, we're trying to look for basically assets that people hate. Valuation will reflect that. If something's really undervalued, something's really cheap, it reflects that people don't like it. And it's just like any other good in any other market. If something's really expensive, it means people like it.
So 2 questions from that. The first is, how do you distinguish, and I already know the answer to this, but how do you distinguish between a stock that is disliked and cheap and a stock that's cheap because it's in trouble?
Yeah. So what you're referring to, we wouldn't do this for individual stocks, but we would do it for regions or sectors or whatever. They're commonly called the value trap.
Yes.
The value trap is something that's cheap for good reason. And so what we do, we have models that try to look at various industry sectors, countries, whatever, that are trying to look for not only cheapness, but some acceleration in corporate profits. Right. And we won't invest in anything just because it's cheap. That doesn't mean anything to us.
It's cheap plus some other indicator.
Correct. So,
And then the other question is, consumer sentiment seems to have gone off the rails post-pandemic. If you look at where, and I suspect this is a measurement problem, but I want to get your sense. So if you look at the University of Michigan consumer sentiment data for the better part of the past 5 years, it's worse than the worst part of the pandemic, worse than the financial crisis, the 87 crash, like on and on. It's shocking, worse than 9/11 and the dot-com implosion. Like, wait, things aren't that bad.
No, they're not that bad at all.
What's going on with that sort of sentiment, and how do you use sentiment when you're trying to manage around this?
You're asking, I think, a more complicated question, maybe even you think you're asking. But, everybody knows that we're in a very uncertain environment. And I think that those consumer sentiment readings right now reflect that immense uncertainty. If you were to ask normal people, they might not use the word uncertainty, they might use the word chaos, there's all kinds of different words that people would use. I think that's what's being reflected in those consumer sentiment numbers right now is the uncertainty and the impact that's having. There's other surveys out there that are showing similar type levels of uncertainty or concern that aren't related to the consumer, but I think it's a reflection of this. It's become a hackneyed word, uncertainty.
Right.
I think that's what you're seeing.
I prefer the lack of clarity to uncertainty, but let me bring this back to your book, Navigate the Noise. How much of this is a function of algorithmic social media, which there was recently a study, I want to say it was Oxford Reuters, that said Americans now get more of their news from social media than anywhere else.
Yeah.
Big issue. And then secondly, it seems like in the world of clickbait,
Absolutely.
crazy headlines, the media itself, if not the news stories or columns, but the headlines certainly seem to be more and more extreme.
Unbelievable. So, I don't know how to answer that from a societal point of view, but I can answer it from my point of view as sort of a fiduciary and an investor of other people's money. I think it is my obligation, 2 things. It is my obligation, number 1, to be as dispassionate about my politics as I possibly can. I mean, if you want to go have a beer, we can talk politics, that's fine. But I'm saying when I'm investing, you have to be as dispassionate as you can possibly be. And number 2, I think it's incumbent of all of us who manage money to search for truly unbiased sources. Not who's going to give us the most frequent news, but who's going to give us news that is unbiased. And I think it's incumbent on all of us to do that. And I have found that in the last year or so, that my choices of news media and what I read and what I pay attention to has changed because of that.
Flesh that out a little bit. Feel free to name names.
A lot of people, I think one of the questions you had planned to ask me was, what are you reading these days? And my answer is, I don't read an awful lot.
Really?
Of these days, because there's so much going on. But what I have begun to do is listen to podcasts. Okay,
Go on. Tell me about this podcast
like
thingy.
This one. No,
right.
but I'm buttering you up here.
All right.
But
Go on. More
three,
sucking up. Sure.
There's three that I would recommend to everybody. One is actually right here, Bloomberg Law. And you'd say, like, why Bloomberg?
June Grasso?
Yeah, exactly. Why would you
really
listen?
good.
Why would you listen to Bloomberg Law?
It's
right?
fascinating.
And my answer is because everything these days is ending up in the courts.
Right.
Have we ever had more issues with government in the courts than ever before?
Certainly.
I'm not a lawyer. I don't know squat about, constitutional theory and everything else. And I'm sure most people don't either, but they're going to listen to some wackadoodle guy talk about this. I'd rather listen to people who are well-grounded opinions and understand the history of law in terms of doing that. So
I'm so glad you brought that up because we went through a run starting in 2020 where every talking pundit Yahoo, first they were an epidemiologist.
Yeah, exactly.
Then they were a virologist. Then they were a constitutional scholar. Then they were a military strategist. When someone asks you, was COVID from the wet lab or wet market or escape from the lab?
Yeah.
It's okay to say, how the hell do I know?
Who knows?
I have no expertise in that. Why are you asking me?
Right, but everybody had an opinion.
So it seemed, right?
Yeah, exactly. And so, the other thing along with that I love is that well-known epidemiologists are idiots, but the guy down at GNC who sells me protein powder, he's a genius, and he knows my health better than anybody. It's just like, come on.
There was a New Yorker cartoon that I vividly remember right in the middle of the pandemic. It's the body of an airplane, and there's a guy standing up in row 17B, right, saying, we're tired of these pilots telling us what to do. Who's with me? And it was like that just sort of let the pilots fly the plane, just sit down.
So Bloomberg Law is one that I listen to. I'm not going to say regularly because I don't have the time to listen to every single one all the time.
Yeah,
but if I get a chance, I listen to it.
That's a fascinating show. I'm like you're surprising me because I do the same as you. I listen to a lot of them. Tell us the other two.
Yeah, so the other two are actually on NPR, which I realize people have now suddenly decided I'm a wide-eyed liberal.
Can I tell you, my wife, every time I get into the car, and she's been driving my car, it's on NPR on satellite radio, and I had the same thought until you listen to a few of them, and they're fascinating.
They are, and there's two shows in particular that I would recommend, two podcasts in particular that I would recommend from NPR. One is called Left, Right, and Center, which, as the name implies, you have three people talking about issues, one from the left, one from the right, one from the center.
Wait, they're going to give us all views? Who could have imagined such a thing?
Who could have imagined that? Exactly. And they pick a topic, and sometimes I'm really interested in the topic, sometimes I'm not, but whatever. The fact that you've got Left, Right, and Center in the same podcast is extraordinarily rare. You don't get that a lot. So that's number one. And the other one is another NPR podcast called Open to Debate, which is very similar. They pick a topic, and this is more like a traditional debate where they have debating rules and all kinds of things. But it's a debate, and you're going to hear two sides of an issue. Now, look, sometimes the issues you don't care about. Sometimes they're very important. Sometimes they're really cool. Sometimes they're not. I get that. But I think it's incumbent on us as a class of money managers and fiduciaries to search out those kind of shows. I would argue if you are a fiduciary and you are constantly listening to MSNBC or Fox or Newsmax or whatever, right, you're doing a disservice to your clients.
For sure. So there are two things I have to share with you because you're right in my favorite space. One is Planet Money on NPR is something that they take this obscure, fascinating little topic and will do a whole, like, way down the rabbit hole, deep dive. I don't know if you recall during the Clinton administration, hey, we're having problems with wealth inequality, and so we're going to cap how much we can pay CEOs in cash.
Right.
If you want to give them risky stock options, you can. And the unintended consequences is it 10x'd the wealth gap. And just stories like that are fascinating. The other thing is you raise a point. I know you're not a lawyer, but I'm a recovering attorney. And the most applicable thing to investing you learn in law school is you have to be able to not just argue your case. You need to know the other side's case better than they do.
Yeah.
And that translates into equities as you can't be bullish unless you can really state the bearish case.
Right, exactly.
And vice versa.
Correct.
You want to be bearish, you better know what are the best arguments for being bullish here. And I can't tell you how many people fail that test.
Yeah.
And I bet you see it back to post 09. If you're super bearish, the only question I have for those people, give me what the bull case is. And if they can't even imagine it, well, now I'm going leveraged long because that failure of imagination means everybody's too bearish.
Yep. And it's interesting you said that. There are times, we don't do this regularly, but there are times where we do point counterpoint in our investment committee meetings exactly for that reason.
Just so you're making both sides.
So we're being sane.
It's one of these things that until you go through the exercise, it like if you have an extreme position and you come out the other side of that discussion and you still have that extreme position, either someone wasn't making the argument well, or hey, maybe the world really is coming to an end.
Yeah.
But so far, that's been the losing bet.
Yeah.
So, given what's going on with technology and AI and automation and all the latest, greatest, newfangled things, is anybody today a better investor than they were 10, 20, 30 years ago, 50 years ago? Has the bar since Charles Dow launched Barron's in 1890, has anything improved for the average investor?
I think the amount of information that an investor can get obviously has gotten greater, right? I mean, even if you think private,
but it's all public. It's Reg FD. So does it help them?
No, I don't think it does. And I think that the notion that somehow we have evolved and we are smarter, better investors than ever before, I think that's hogwash. I think that's complete hogwash. People are still underperforming like they always did.
So it's not the strategies, it's not the vehicles, although we get great tax and cost benefits with ETFs. How much of this is just simply comes down to human behavior and human nature,
right? And
people are still people, and we're still making the same mistakes over and over and over again.
Yeah, I mean, there is something to be said for behavioral finance, and the biases that we bring to the table. It's pretty hard to not be human.
It very much is. So let's bring this back to where we are in the market today and what's going on. We just made new all-time highs in the S&P and in the NASDAQ. I always learn that all-time highs are the most bullish thing you can see. Perhaps not the very last one, but the 100 before it are super bullish. How do you look at the market and say everybody seems to dislike this market, and yet we made fresh all-time highs?
Yeah, so I think, Barry, that we've said a number of times that we think it is a mistake right now to think of the market, sort of in quotes, that's what people are very very focused on right now. And we think that's a mistake. Why is it a mistake? Because the market is dominated by 7 or 10 or 15 companies. And we really have an extraordinarily bifurcated market in that respect. And I'm not saying anything that people don't know. Of course, everybody knows about the Magnificent Seven. Who doesn't?
Although the Mag 7 have been the Lag 7 for most of this year.
Correct. Now that's where I was going. Exactly right. But the enthusiasm surrounding those 7 stocks is not changing. And our view has been that, okay, you want to go play those 7 stocks, go play the 7 stocks.
Right.
You don't need us. We're looking at everything else in the world. And I've said to our investors many times, are there really only 7 growth stories in the entire global equity market? Of course not. There's tons of them. And we've shown people how many companies are actually growing earnings 25% or more, and how the Mag 7 doesn't really even fit into that group, that there are companies that are growing, much faster with similar consistency. And so I think if you're invested in an S&P index fund, or you are invested solely in the Mag 7 or solely in NASDAQ, I think the next 3, 5, 10 years might be very disappointing. I think if you're in everything else, and we could define, I'll leave it to everybody else to define how they define everything else. But I think if you're in everything else, I think you're going to do just fine. I think you're going to have a great time.
So let's talk about not everything else, but one of the else things, which has been international stocks. When we look at either developed ex-U.S. or emerging markets, these are areas that have underperformed the U.S. for 10, 15 years.
Absolutely.
And over the past year, we've started to see signs that, hey, maybe this underperformance isn't going to persist. Ex-U.S. stocks have been doing much better than U.S., certainly year to date in 2025. And we're recording this late June. Maybe it's been about a year or more of outperformance. How do you look at the world of international stocks? What parts of the world look interesting to you?
So I will twist your question a little bit, and I will say that one of the aspects, one of the segments of the global equity markets that we are very bullish on is what I will call international quality, non-U.S. quality stocks.
That's not a twist.
Well, I'm just saying as opposed to a country or something. People like to talk about countries. But I think the reason I say this is that the median projected growth rate among high-quality non-U.S. stocks is actually equal, maybe even a touch higher than the median growth rate among the Magnificent Seven.
Wow.
So we'll talk basically similar type growth. They offer dividend yields of 3%, 4%, maybe a little percent, maybe even 4.5%, depending on how you look at this. But let's say 3 to 4% dividend yield. And they sell for a third to a half of the valuation of the Magnificent Seven. So the way I describe it to people is, if somebody came to you and offered you a Maserati for the price of a Chevy, or to be fair here, if somebody offered you Manolo Blahniks for the price of Hush Puppies, I think we would all say, yes, I will do that. By the way, can I have two?
Right.
But when we get to the stock market, this is like unimportant to people. They don't understand that there's a value assessment made in everything we do all the time. But for some reason in stocks, it doesn't appear. So the way I describe it is, the Blahniks and the Maseratis are on sale. We think that's a great thing to do. We'll take two. Thank you.
So you're naming two Italian companies.
Well,
Blahniks, Paris.
I just chose them because everybody knows.
But the
them.
reason I bring that up is you're not stock pickers. You're geography sector style selectors.
Right.
So if someone says, hey, that Rich Bernstein is onto something, I want exposure to fast-growing, high-quality, inexpensive companies, what sectors are they looking at?
So for us, I will name the ETF that we hold with all due legal disclaimers here that we hold this ETF, we have held it, we still hold it, blah, blah, blah. However I can alert people that I'm talking my book a little bit here. It's the IQLT is the ticker symbol, the International Quality ETF. And it's a great way. It's actually, I believe, IFA-based. So you're getting multiple countries. It's probably about
Europe and the Far East and Asia?
Correct. It's probably going to be Australia. It's probably going to be about 60 to 70% Europe. I don't have the stats in front of me, but something like that. So I think, that's an area that people aren't thinking about at all.
So here's the macro pushback. And I'm not saying this is, let me just play devil's advocate. Europe has structural problems. Brexit is an issue. Now, with the Trump administration, Europe's going to have to step up and fund more of their own military and defense. Europe has problems, and they're not going to be clear of these for decades.
And that could be true, or that might not be true. Okay,
but is it relevant?
But notice what I said was that they offer earnings growth that is comparable to that of the Mag 7. And I think that's the point that I'm trying to make, that despite all these problems that everybody is well familiar with, somehow these companies are putting, or have earnings growth, projected earnings growth that's roughly similar, a little bit more than the Magnificent Seven.
And these are quality companies, and they're ex-U.S.
Ex-U.S. all.
And so if you have a huge home country bias and you want a little diversification, you can look overseas to reasonably priced quality companies.
And if you think the dollar is going to weaken, it's all the better.
What are we down, 8.5% year to date, something like that?
Yeah. Exactly.
So I know you're not a currency analyst and you don't make those sort of calls. How do you look at what happens post April 2nd, Liberation Day, and the ongoing weakness in the dollar. Does this come into your calculus, or is this just more noise that nobody is?
It does, not in terms of the short and intermediate term the way most people would think, but we think there are structural issues in the United States that transcend the current politics, and have been around for longer than people think, and are detrimental to the U.S. economy. And we find that very interesting. That, you hear all the time about debt and deficits, and there's some day of reckoning coming.
My entire adult life I've been hearing.
Yeah, and I love that, because the speaker usually is saying, I have some insight, and for some reason the markets don't appreciate my insight. Right. And I love that. We're all so smart and the market's stupid. No, it's actually the other way around. The markets have figured this out over the past 10 to 15 years. And what I'm talking about is, if you look at the spread between treasuries and AAA rated sovereign debt through time, what you will find is when the United States was rated AAA, our yields were roughly in line with other AAA rated sovereign debt. Since the initial downgrade in 2011, and since then nonstop, we have sold at a risk premium yield. In other words, we're trading more like a lower quality bond relative to AAA rated sovereigns.
Meaning all this negativity is in the price already.
It's there. The markets have been well aware of it. There's no day of reckoning. It's like a slow bleed. Right. And so if you think about how everything in the United States is priced off the 10-year, mortgages, right, munis, corporate bonds, everything's priced off the 10-year. The fact that we're paying it at right now it's just under 200 basis points of extra yield because of our lack of fiscal discipline. That's translating through to higher interest costs throughout the entire economy. It's not just the government, it's through the entire economy. Why aren't people aware of this? Well, because over the past 5 to 10 years, we've had low absolute rates of interest. The point I'm trying to make is we've still been penalized relative to other countries despite that absolute low rate of interest, and people haven't realized that. So we're already being penalized, and I think there's a real I think everybody should be concerned about that. It's clear that neither party has a real interest in fiscal discipline right now. So we should assume that penalty against the United States is going to continue to exist, if not expand.
So let me push back and play a little devil's advocate about that. Mm-hmm. Hey, Uncle Sam was borrowing at next to nothing. We've been running up deficits for 100 years. Mm-hmm. COVID happens. Everybody's stuck at home. CARES Act 1 is the biggest fiscal stimulus, at least as a percentage of GDP since World War II. Then you add the second CARES Act under Trump, the third CARES Act under Biden, to say nothing of the other 10-year fiscal stimulus plans passed under Biden. And that pig working its way through the python caused a giant spike in inflation, plus supply chains, blah, blah, blah. Mm-hmm. And now that's come out the other end, and so the Fed had to respond. Mm-hmm. Whether the Fed brought inflation down or it was simply unwinding naturally is another debate. But once the Fed brings rates back down, this penalty will go away if and when the Fed finally does that.
Well, that's important because remember, in the period I'm talking about, which is almost 15 years now, you've got periods. You've got multiple presidents. Mm-hmm. You've got multiple Fed regimes, and the penalty doesn't go away. And I think that's
so. No matter, even at zero, we were paying a penalty because other countries had negative interest rates.
Right.
So there was still the penalty.
We were still being penalized. It's crazy, and that I think is something that's lurking in the background that people are not paying attention to, especially people who say that a day of reckoning is coming.
You're saying it came and it's still here. It's ongoing.
It's ongoing. It's just not big enough for anybody to notice. It's like as I said, it's like water torture.
The slow bleed.
Slow bleed.
That's really fascinating. Let's jump to our favorite questions. Starting with, you mentioned some of the podcasts you're listening to. What else are you streaming? What's keeping you entertained these days?
So streaming, I'm in a little bit of a rut in streaming right now. Yeah, I'm having trouble. Everybody, everybody's got their favorite streaming show that they like, and if you ask anybody, people come up with like 4 of them. Oh, you got to watch this. You got to watch this, and all of a sudden it's like it all blends together, and you can't keep it together. So I'm a touch lost right now in terms of streaming. I won't say give me suggestions because I won't remember it as soon as I leave.
I'm just going to give you one because it's quirky and interesting.
Okay.
It's called Department Q.
Department Q.
Right. So this is a limited 9-episode series on Netflix. Detective is shot. His partner is injured. The third person is killed at the site. And he basically is appointed head of the cold case division, which they're just standing up.
That's the kind of stuff I love.
And it's in Scottish.
Stuff.
And I normally don't love police procedurals.
Yeah.
This is kind of fascinating.
Department Q.
It sort of builds slowly over time. Like I could give you 100 others that you wouldn't care about, but I kind of know the sort of stuff.
Good. That's a good
you
one.
like, but it's quirky and weird, but really interesting.
Good.
If you're going to have any complaint over it, and I don't think this is a complaint, but the complaints I can imagine are, well, this builds slowly. I'm like, it's not just,
okay.
If you want to open with a chase scene, James Bond and Mission Impossible,
there you go.
You know where to go find. This is a little
cool.
more.
Okay.
So, well, I'm curious to see
Department
how you...
Q?
Department Q. Such an odd... let's talk about mentors. You referenced one of them. Who were the folks who helped shape your career?
So I would say there were several. One that had an immense impact on me was the person who hired me at Merrill, Chuck Clow. Mm-hmm. Chuck Clow at the time was Merrill's chief strategist.
I know that name from way back when.
Yeah. He was the chief strategist at Merrill from 87 to 2000, something like that.
Wow.
And Chuck gave me 2 pieces of advice, which he claims he doesn't remember that he gave me, but I'm sure he does. The first was my first day when I walked in at Merrill, and I kind of said, like, what do you think I should be focusing on? And he said to me, I don't really care, just don't make a fool of yourself.
By the way, that's good advice for anybody, anywhere, anytime.
It was, and at first I was very put off. Like, this guy doesn't care about me? Like, what is this all about? But what he was saying was, you're a grown-up.
Right.
You
act like it.
Yeah, exactly. You don't need me to tell you what you should do, but be aware. Don't make a fool of yourself. Don't do stupid things. Second thing he told me, which I live by to this day, and I tell this to people all the time, he said, make sure you're a star and not a Roman candle.
Huh.
Which I still think to this day is fantastic advice.
So persistency, don't just flame out.
Don't flame out. Don't be the 10-minute, thing. Be the star. That to be a star is harder than you think. But be a star, don't be a Roman candle. That I still, to my day, live my professional career that way.
I think that's great. You said you don't read a lot, but you've written several books. I know there are books that have influenced you. What are some of your favorites? Do you read anything on vacation?
So I do. What I tend to read, I don't have any one book that I would give you, but I will tell you, I tend to read a lot of espionage, spy and espionage type stuff.
Okay.
And the reason why is that as these things progress and as the stories progress, not like, as you said, not like James Bond type stuff,
right?
But it's almost like solving a puzzle. Mm-hmm. Or completing a puzzle in some way. And I find that fascinating. I find, I was always in high school, my favorite math was geometry because everything was a puzzle to me. There was we had different tools. How do you solve the problem? And that's kind of the way I view spies and espionage is that there's different tools, but how do you solve the problem and how do you get where you want to go?
I have another recommendation for you.
This is why I came today.
It was it was one of these films that this looks interesting. Netflix recommended. Let's try this. Black Bag. Set in the UK, MI6, husband and wife work together. Mm-hmm. And there's a mole somewhere in MI6. And people, somehow each of them are led. I want to say is it Kate Winslet? It's one of the Kates. And I forget who's the lead husband, the husband. But each of them begin to suspect the other.
Oh, interesting.
And shockingly interesting. Like normally you go into a movie you have no idea about. And, let's see how this is. And we both were like, wow, this was surprisingly good. So, again, I know your wheelhouse.
Yeah.
Black Bag and
Bag.
Department Q. You have now a film, a series, and a book. I've taken care of your summer's entertainment. So anything else you want to mention that you're reading?
No, there's not. I haven't been reading a lot recently for fun, I have to admit. But what I do read, pretty religiously is getting back to the whole issue of being dispassionate. I do read the Financial Times. I do read The Economist. To me, that's a must read for people in our industry.
Found the British papers generally, like what we think of as left of center, is sort of dead middle to them. And their right is kind of our middle. Like it's not like our spectrum feels wider, our political range, and everybody seems to be clustered somewhere around. It's either center right or center left, not extreme right or extreme left.
And I actually don't. I don't care whether people are right or left, as long as I can figure that out. What I care for is factual content.
Right.
Fact checking has to be good these days.
So our final two questions: what sort of advice would you give to a recent college grad interested in a career in either investing or asset management or quantitative strategy?
Yeah, so I mentioned this briefly before. The advice I do give recent college graduates or seniors or whatever is not to pigeonhole yourself early in your career. Don't say, this is what I have to do. And this is what I'm going to do. If you're a doctor, if you want to be a doctor, if you want to be a lawyer, you have to, some of that you have to do. I get that, right? But if you want to go into the financial services industry in any format, you have to enter that with an immense amount of flexibility. Our industry changes so dramatically and so quickly that what seems super interesting to you as a college graduate could be obsolete in 2 or 3 years.
Right.
And you don't want to paint yourself into a corner where that's all you know. And that's all you're willing to do, and you're unwilling to do other things or unwilling to learn other things. I think if you're coming into financial services, you should be one who likes to learn and likes to morph through time.
Really, really interesting. And our final question: what do you know about the world of investing today that might have been helpful to know 40 years or so ago when you were getting started?
Oh, man. I mean, I will tell you, I have gone back and read reports that I wrote 20 years ago or 25 years ago. And I read them today and I say, like, what a moron. I mean, I'm amazed at my own stupidity. And so
I'm going to interrupt you right here to say, so Professor David Dunning of University of Michigan, he of the famous Dunning-Kruger effect, said, if you look at work that's 5 years old and you don't think it's awful, you're not progressing or growing.
Right? Oh, is that right?
Absolutely. I said it right sitting where you were sitting. And said, if you don't hate what you did 10 years ago, you haven't grown at all professionally.
I cringe.
How fantastic is that?
I mean, some of the ideas I wrote about, we still use, and they're still the crux of it. But I'm just saying, I look at my writing, I look at how I express myself, I looked at how I thought something was so important, that type of thing, and I cringe today. I absolutely cringe. And the moral of the story there is I've come to grips with the fact that no matter how smart I think I am, I'm really not very smart, and there's a lot more to learn. And so I think as I've gotten older, I've wanted to learn more through time. I kind of immerse myself, and it's funny because my friends react to me down there, say, like, how did you know that? And it's only because I'm reading all kinds of different things and doing all kinds of different things and paying attention to different things, because I kind of think of myself as a perpetual moron. I don't know how else to describe it, but that's really how I view myself.
All I know is that I know nothing. I will go back to philosophy. What is that, Aristotle? So we'll end where we began. Rich, thank you for being so generous with your time. We have been speaking with Rich Bernstein, founder, Chief Investment Officer of Rich Bernstein Associates. If you enjoy this conversation, well, be sure and check out any of the 550 we've done over the past 11 years. You can find those at Bloomberg, iTunes, Spotify, YouTube, wherever you feed your podcast fix. Be sure and check out my new book, How Not to Invest: The Ideas, Numbers, and Behaviors That Destroy Wealth and how to avoid them, how not to invest wherever you find your favorite books. I would be remiss if I did not thank our crack team that helps put these conversations together each week. Anna Luke is my producer. Sage Bauman is the head of podcasts at Bloomberg. Sean Russo is my researcher. Peter Nicolino is my engineer. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.